Guy Menon, and I'm the Research and Knowledge Manager with Making Finance Work for Africa. Today's webinar will be a discussion on Sub-Saharan Africa's interbank markets. We'll unpack some of the knowledge, lesson, and policy recommendations of a study led by a team of researchers from ODI. But before we jump into the subject, allow me to go over the housekeeping items. 210 individuals registered for this webinar, which will last 1 hour. All microphones are muted, and you can ask questions live during the session or by using the Q&A box at the bottom of your screen. As always, slides and recording of the webinar will be available after we conclude this session on Making Finance Work for Africa's portal. In case you are experiencing any technical issue, please feel free to send a message and we'll be happy to provide technical support. Finally, please remember to fill out the survey. There's a survey that will appear automatically after the session. We are interested in your feedback and we really look forward to your comments. This ends our housekeeping. Just briefly about Making Finance Work for Africa, it's a G8 initiative hosted at the African Development Bank. It's a multi-donor initiative with a focus on financial inclusion, long-term finance, and financial stability and regulation. Our members include the GIZ, AFD, Afrexim Bank, the European Investment Bank, the European Commission, and Mimbuza. You can also access thousands of articles, news, and publications on Making Finance Work for Africa online library. This closes our brief introduction of Making Finance Work for Africa. Today's session is chaired by Victor Morende. Victor is the AXA Chair in Global Finance and Director of the Center for Global Finance at SOAS University of London. Without further ado, on to you, Victor, for the session. Thank you.
Thank you very much, Guy, and for introducing me. Let me also thank you and your colleagues, as well as our colleagues at ODI, for inviting me to moderate the session today. I would like to start by making an observation that research on interbank markets in Sub-Saharan Africa is relatively recent. And I can recall that about 10 years ago, the first ever empirical work was undertaken at the Central Bank of Kenya, sponsored by the Kenyan government and the World Bank in about 10 years ago. And following that important seminal study, then a couple of years later, starting in about 2016, we started a project funded by the ESRC in the UK and the FCDO, that among the main topics of interest was the interbank market. In addition to that, of course, a number of scholars all over the world started on working on the interbank market in Sub-Saharan Africa. So I'd like to first congratulate Sherin Raga and Judith Tyson for actually making the great effort of being able to put all these studies, together, which have been over the last 10 years, and make a lot of sense out of them by being able to capture, the progress in terms of what empirical work has been done, what new innovations and research have been done to address the developments in the markets in Africa. And secondly, also to be able to identify the barriers that these markets face. Some of them are structural barriers, as you will note in the presentation, but also some are impediments that could actually be swept away with a single stroke of the pen on regulation. And that's where the third component on the policy issues, the policies we have in place, and possibly through the discussion today, are the policies that need to be in place. And so I'm glad that we're having this conversation and learning from the report. I think we proceed in a very structured way. So I will start by asking Sharon and Judith to make a quick presentation of about 15 minutes to us. You know, I suppose you have seen the report. And thereafter, we have two distinguished speakers whom I will invite as guest speakers. And then I will turn to you at the audience to get some ideas, observations, comments to us, and then we can have a full discussion. So on this, let me now have the pleasure of introducing the speakers very briefly. Sharon Raga is a senior research officer at ODI in London, and I know has been working on this for quite some time, and presenting the work very successfully. And is also joined by Judith Tyson, who is a co-investigator in the ESRC research project I mentioned, but here is coming in as a research fellow and also a DEGRP finance lead at ODI. And then we are fortunate to have guest speakers who are commentators making very important observations. And these will include Ingrid Hege, who is the Vice President for Strategic Projects at Frontier's Technical Assistance Program, and has a great portfolio in work at IFC and other organizations. And also we have also a speaker, Samir Chiliongo. And Samir is one of the original group of people that was by that time at the Central Bank of Kenya that started into looking at the empirics of the market microstructure, various dimensions. We're a group of about 8 people, including Samir Chiliongo. So he's a veteran researcher in this area as far as Sub-Saharan Africa is concerned, and is now director of the Center for Research on Financial Markets and Policy at the Kenya Bankers Association. That's a great team, and we should be able to get very tremendous insight into the end of these issues. So, great pleasure. Call upon you, Sharon and Judith, to present in about 15 minutes. Thank you very much.
So thank you, Victor, for that introduction. So good afternoon, everyone. It is our pleasure today to present to you the findings of the DEGR paper on Sub-Saharan Africa's interbank market. I am Sherilyn Raga, Senior Officer at ODI, and together with my co-author, Judith Tyson, we would like to thank you all for participating today. And we are also grateful to our colleagues from Making Finance Work for Africa for making this webinar possible. So for a brief background, some have been touched on by Victor earlier. This paper presents a landscape of the interbank market Sub-Saharan Africa, including the recent evidence on the factors that hinder their development and the policy implications for financial regulators. So this paper's analysis benefited from existing literature funded by the UK ESRC and FCDO through the DEGRP, as well as from peer review of academic researchers in this field, as well as central bank practitioners in the region. So for an outline of our presentation today, we will focus on 3 main areas. First, I will discuss the progress of the interbank market development in the region, and along the way, I will highlight some country-level examples. Second, I will present the key barriers to interbank market development in the region and their impact on borrowing costs, risk management, and monetary policy transmission. Finally, Judith will discuss the financial stability surrounding the interbank market and then some policy implications. Next slide, please. Okay. So before I start presenting the state of play of the interbank market in the region, let me give an overview of the main channels through which the interbank market can benefit Sub-Saharan Africa. So broadly speaking, a well-functioning interbank market affects financial deepening, development, and ultimately financial stability. Theoretically, all this can potentially lead to lower financial costs to the real economy. So you can see the channels of these benefits from the right-hand side of the slide. So first, the interbank market provides a platform to redistribute liquidity between banks. And in this process, it improves price discovery and encourages competition. This increase in competition is then expected to increase the lending at efficient and lower retail lending rates. Second, as a conduit of monetary policy transmission, interbank rates can directly affect the loan pricing of both large and small banks. Thus, it can affect the pricing of the much needed lending for Africa's productive sectors and also SMEs and potentially also to households. Interbank market can also act as an insurance against liquidity shocks. This is so since the interbank network essentially provides a secondary market for diversification of funds. Essentially, it means that banks with excess funds can lend faster to distressed banks in short of liquidity, especially in distressed times. So finally, the interbank trading process is also underpinned by peer monitoring of counterparty risk, which in turn effectively improves the risk management of individual financial institutions and thus contribute to the overall stability of the financial system. So this continuous process of the interbank market's beneficial effects on financial development and access and macro financial stability provides a conducive environment for increasing the demand and production, which ultimately leads to economic growth. However, what we learn from existing literature and probably most of the practitioners in this webinar are already aware of is that the interbank market development in Sub-Saharan Africa is far from perfect, at least at this point. So at the left-hand side of your slide, you can see the current characteristics of the interbank market in the region. So first, it is small in scale. For instance, interbank trading is gradually increasing up to 30% of GDP in Kenya, Malawi, Uganda, and Zambia. But interbank transaction remains small in some countries. For example, it is only equivalent to about 1.3% of GDP in Nigeria and 4.8% of GDP in Ghana. In addition, interbank transactions in the region are largely limited to an overnight basis. For example, the share of interbank trading that matures overnight is 95% in Malawi, 90% in Uganda, and more than 50% in Tanzania. In Kenya, virtually all interbank transactions mature overnight. Meanwhile, some studies also suggest that, because the interbank market is largely composed of unsecured transactions, for example, this is the case for Kenya and Tanzania, this may have been limiting the access of smaller banks to the interbank markets. This is also reflected in the dominance of collateralized transactions in markets where both secured and unsecured instruments are available. So for example, in Nigeria, 96% of all interbank trading are collateralized, especially in 2018 when it's a bit unstable. When the macroeconomic is a bit unstable. So there are also challenges around interbank transactions that heavily rely on government deposits for liquidity because it effectively exposes the interbank markets to government shocks, and also around large banks holding the dominant holder of liquidity because effectively this gives them control over the interbank market. So there are also some challenges on information asymmetries among participants, which may have been keeping the interbank trading between banks generally low. For example, there are reported opaque internal credit limits of international banks in Uganda and Tanzania. In the case of Malawi and Zambia, banks end up accessing central bank lending facilities rather than the interbank market, despite the system having existing excess liquidity. So so that's the broad picture of the development of the interbank markets in selected African countries. So amid all these current developments and gaps in the interbank markets, central banks are catching up in providing financial infrastructure. They continuously enhance their lending facilities and payment systems, and crafting tools to balance development of the interbank market, but also trying to manage the financial stability around it. So this is somewhat expected since, as Victor mentioned, interbank market is relatively young in the region. It flourished in like late 1990s, and many of the central banks have just transitioned or are still transitioning from like monetary to inflation targeting, and some have just recently established real-time interbank platforms, and the presence of like regulations or even code of conduct directed to interbank market players are typically low. So having presented to you the state of the interbank market in the region, the next natural question would be, how do we develop the interbank market so we can gain the potential benefits from it? So the first step to answer this question, of course, is to identify the factors that hinder their development. And based on our review, we find that there are two, and probably these are the most critical barriers that impede the interbank market development in virtually all the sub-Saharan countries we covered in our paper. First is market segmentation, or the differential pricing and access to interbank funds, which in most cases favors large and foreign banks. Second, the high levels of perceived risk, and this is driven by information asymmetry, price stickiness, and the general uncertainty associated with underdeveloped financial market. Next slide, please. So instead of the benefits from a well-functioning interbank market we discussed earlier, what we find is that the current state of Sub-Saharan Africa's interbank markets, characterized by the pervasive market segmentation and high levels of perceived risk, is falling short of its potential to contribute to Sub-Saharan's financial market development. First, in terms of borrowing costs, you can see this in the right-hand side of your slide. So small banks in the interbank market are charged higher borrowing rates than their peers. This is very common in Kenya and Uganda. Meanwhile, favorable rates are granted between banks of similar size and ownership. For example, intra-international banking group transactions represent 80% of interbank trading in West African Economic and Monetary Union Zone. So, but interbank transactions are generally charged with higher rates. So because of this, consequently, like deposit and lending spreads remain high in Sub-Saharan Africa at 10.6% as of 2018, much higher than 5.6% spread in South Asia or 3.6% spread in Middle East and North Africa. In terms of risk management, well, on the bright side, there is evidence on the presence of peer monitoring effect of the interbank market in Kenya, Uganda, and Malawi. For example, the findings of one of our speakers today, Mr. Samuel Triongco, suggest that both interbank rates and interbank trading volumes have a market disciplining effect in terms of enhancing banks' capital adequacy ratios. However, a bit on the downside, as in the finding of our chair, Victor, is that this peer monitoring effect is only up to a certain threshold of interbank activity, and the effect is generally weak for large or systemically important banks. So finally, on the effectiveness of monetary policy transmission via interbank rates, well, what we find is that in some cases, for example, in Ghana, retail rates remain high despite monetary policy easing and declines in interbank rates. This is due to banks' high buffer provisioning, especially in periods of fragile macroeconomic environment. There are also observed deviation between monetary policy and interest bank rates. For example, in the case of Zambia, interbank rates remain, it has been like above the central bank's policy rate for about 80% of the time from 2012 to 2017. And this is attributed to some periods of policy uncertainty from the central bank. However, again, on the brighter side, in Malawi, there is some evidence on the effectiveness of monetary policy transmission via interbank rates in lowering lending rates in the economy. But the empirical result is a bit less robust at this point. So these are the pictures of the current impact of what we have, on what we have right now for the region. But around this, there are also bigger issues of evolving financial stability risks surrounding interbank networks and interbank hubs that are typically dominated by systemically important banks. So now I will hand over the presentation to my colleague Judith Tyson, who will discuss these issues and some policy implications.
Thank you very much, Sherilyn. Maybe we can have the next slide. So as Sherilyn mentioned, the structure of interbank markets that we've seen evolved in the region is quite specific, and particularly around this issue of clustering. And also the benefits or the potential benefits of interbank markets have only partially been realised to date. The other issue there that we need to take into account is the fact that interbank markets also bring with them, as well as opportunities, financial stability risks. And in particular, when we look at policy, we need to balance those two goals between deepening and financial stability, which of course is always the fundamental problem with supervision and policy setting in developing economies. When we think about the risks that they bring, in particular, they bring contagion risks. And that's, of course, because interbank markets link the institutions within the financial system in their inherent nature. I think it's also important to note that those risks are also common to advanced financial markets, where interbank markets are very deep, and they can be very significant. And in particular, I'd highlight as an example, they were very important in transmitting risks and really creating a systemic collapse in 2008, for example, after the collapse of Lehman Brothers and the global financial crisis that continued from those events. What's interesting for African financial markets, and that's a clear implication that came out of the research papers that we looked at, was that the fact that interbank markets have hub banks and sort of are clustered around some of the larger and stronger banks means that these banks are particularly important to contagion risk. It's also notable that clustering or concentration risk is greater during periods of market stress. And that was noted, for example, in Kenya, in Malawi, by some of the researchers who examined how clustering evolved during periods of market stress. In terms of what the policy implications are, obviously number one is around the supervision of the hub banks. Many of them are already systemically important institutions, but largely based on their scale relative to the financial markets in which they sit. But obviously the fact that they are also becoming critical in interbank markets means that we need a doubling down in terms of the institutional soundness of those banks and the macroprudential supervision around them. The second piece also comes out of some of the remarks that Sherilyn made, which is really about the need for collateral. Now, that, of course, can tackle the fundamental issue around the perception of high levels of risk, which is driving the market structure that we're seeing today. Ideally, we would like to see collateral being driven by government securities, which tend to be the most liquid and credit-worthy collateral that can be provided, particularly with these sort of short-term markets. However, in the African markets, or in some African markets, that can actually be quite difficult in practice, because either government bond markets are thin in terms of their liquidity, and also because, and again, particularly in periods of market stress, their credit ratings can be an issue in terms of the soundness of that collateral. One of the potential alternatives is guarantees, and Ingrid will speak a little bit about her experience in trying to execute that in the region in a moment. A third implication is around the role of central bank liquidity. Now, again, this has sort of been an important breaker in terms of the chain effects in contagion risk. But it's also something that has been used widely, again, in advanced financial markets. And a nice example of that was last year during the C-19 crisis, when we saw, of course, the collapse in markets in March, and the central banks in advanced economies flooded the markets with liquidity to prevent this type of contagion risk getting a grip. However, again, and I think it'd be interesting to see if we've got any central banks who'd like to comment on this, that can be difficult within African economies. And last year, for example, we saw central banks seeking liquidity in order to support the financial system in the event of that type of shock. But some of them found that difficult to source, particularly as a note in terms of this periods of market stress. Lastly, the other option is around reserve requirements. There was some debate about this amongst the researchers because reducing reserve requirements looks like a tempting option, and particularly reduced periods of shorter periods of maintenance or lower reserve requirements in order to provide greater liquidity. But it's something that's probably most suitable for periods of market tranquility, and of course those risks can change very rapidly and catch you out in terms of the institutional soundness. So it's something that needs to be carefully managed, but nevertheless, it is something that can potentially accelerate development in markets. Let me finish that and hand back to Victor.
Thank you very much, Sharon and Judith, for being able to share with us the summary of your paper, so quickly and so clearly. I think let me also just explain the fact that in any of these economies in Sub-Saharan Africa, you have quite a huge number of commercial banks participating in the interbank market. Of course, for their shortfalls on everyday transactions between the banks and the companies as well as individuals, they could easily resort to the central bank and get quick access to funds. But that's not always helpful, because it may give a signal in terms of the central bank, in terms of how some of the commercial banks are getting into some deficit. So the emergence of these interbank markets basically enable these commercial banks be able to, those that have surpluses, to lend to those banks which have deficits almost on a daily basis or on a weekly basis, depending on the trading of the interbank market. And I was very delighted to see in the audience a number of people who have been very active on the projects we have. The projects have been, say, on Uganda. I can see Thomas Guide from Bank of Uganda is active in a very great empirical work. In Kenya, for the Central Bank of Kenya, we already have Samir and a couple of colleagues in the audience. And Bank of Zambia, we can say Jonathan Kipimo, who has been very active in leading that research on Zambia. And in Malawi, I can see Hassan Ahmad from Lafubra University, who is supervising the work on Malawi. So I think that we'll have great conversations building on the excitement that Sharon and Judith has already caused in summarizing this work. At this time, I would like to invite the guest speakers or discussants, and these basically Ingrid Hangen and Samir Tuliongo. Let me start with the Ingrid. And Ingrid, just in about 5 minutes, if you could share some of your views and reaction to this presentation.
Sure. Thank you very much, Victor. And let me underscore how much we agree with your perception about overnight facilities. And indeed, the purpose of an interbank market is really to solve and distribute the liquidity amongst the banks themselves in order to create the risk management and the financial soundness which you want to achieve. And thank you also for the African Development Bank and all the partners for the opportunity to be speaking here today. It's a pleasure to reflect on the excellent work done by Sherilyn with Judith. It's really appreciated. We at Frontclear, of course, have been operating in interbank markets for a while, but I can say that there is a bit of a dearth of interbank research when it comes to Sub-Saharan Africa. So it really filled in quite some gaps. And certainly we can underscore the conclusions. We confirm that we see that in our work across the continent. Many Sub-Saharan African markets do indeed face that structural challenge of market segmentation. And in a crisis, let alone in normal market conditions, the perceived or otherwise counterparty credit risk quickly dislocates those banking relationships. Larger banks, as you pointed out, Sherilyn, often carry the lower borrowing costs and trade only with one another in what's called the tier one segment, so to speak. And smaller players who carry the greater weight when it comes to serving the SMEs are locked out or have higher borrowing costs, despite overall market liquidity, which again is simply not distributed efficiently in the system. Banks are not able to fulfill their core role to effectively extend loans and financial products to the real economy, the businesses and the households. So it's often a discussion that FrontClear has about, the pipes of the system are really about money markets and interbank markets. And until you get the pipes right, the faucets don't run properly. So my name is Ingrid Hagen, and indeed I'm Vice President for Strategic Projects at FrontClear, which includes heading up our technical assistance program. For all of you participating who might not be familiar with FrontClear, I mentioned we've been around a while. We've been around since 2015 and dedicated to the development of a more stable and inclusive money and interbank market in developing countries. FrontClear is centered on diagnosing money market challenges in collaboration with local players, central banks, market actors, and tackling them for the provision of technical assistance and guarantees to cover counterparty credit risk. As Judith pointed to, these guarantees are issued on the back of local government, local currency government securities, because we feel it's incredibly important to build that market. To date, FrontClear has facilitated over $1.5 billion in interbank market transactions through the issuance of just over 800 million in guarantees. That means for every dollar that's guaranteed, yet another full dollar of interbank funding has been mobilized. We've set up structural partnerships with about 10 regulatory authorities, most often central banks, to support the development of the interbank markets. In practice, this has led to about 17 legal and regulatory reviews and reforms. Some of the achievements to date include countries adopting GMRA as a market standard for transaction documentation, and even leading to closeout netting regulation. Of course, both of these are incredibly central to the legal certainty that's required to make interbank markets more secure. FrontClear operates in a kind of a unique space amongst development finance community in the global capital markets, and with local central banks, banks alike, and technical experts and infrastructure providers. I think what I'd like to focus on here today is the financial system recovery and money market resilience. We've alluded a bit to the kind of situation we're dealing with right now in a COVID-19 pandemic environment. And I'll start with a quote from Isabel Schnabel from the European Central Bank. She's a board member. Money markets are a cornerstone of the financial system. Banks, non-bank financial institutions, and non-financial corporations all rely on money markets for their short-term funding, liquidity management, and collateral needs. As a result, dislocations in money markets can severely undermine the stability of our financial system. And as we all know, the nucleus of money markets is interbank funding, where banks borrow and lend to each other using financial instruments such as repos and hedging balance sheet risk through derivatives. Central banks and banks rely on interbank markets to deal with immediate liquidity concerns and to transmit monetary policy. Today, we're in a market of stress. Many African money markets are dislocated, to use Mrs. Schnabel's language. And at a time of COVID-19, the key barriers pointed to this study shared today are likely to be exacerbated. Rising NPLs across markets' financial sectors and the potential for further entrenched risk and market segmentation. Sharp increases in government debt in the pandemic environment in their response is impacting further crowding out of the private sector lending. The costs of shallow interbank markets will likely become even more prevalent in 2021 onwards. And the extent of all this on bank balance sheets will become clearer as their access to markets will likely diminish as a result. So for a wide variety of Sub-Saharan African countries, there's a very nascent interbank market characterized by entrenched market segmentation, and a prolonged pandemic will actually challenge recovery. Markets that had better developed currency markets and bond markets were better positioned to respond to the fallout of the pandemic. Judith pointed to the GFC 2018 conditions, of course, in developed markets since the GFC. The mitigation and what has been applied has certainly increased the security of the markets and reduced the impact of any shocks, including that of the pandemic we're dealing with right now. So they've moved to secured interbank markets and safer, more resilient financial systems. My point here is that an immediate interventions are needed to tackle market segmentation and other interbank market barriers, and to support the resilience of money markets, sub-Saharan money markets to future shocks. Of huge importance is the enabling local infrastructure. And Frontclear itself spends quite a bit of time dedicating efforts together with central banks to develop the legal and regulatory frameworks that support secured transactions and institutional trust, and clearing and settlement to ensure smooth processes and finality. Many such achievements are being realized across Sub-Saharan Africa, and I think it's worthwhile highlighting them because they are examples. This past week, the ICMA and Frontclear just held a webinar on Uganda's repo markets development. The Deputy Governor of the Bank of Uganda and the panelists spoke to a draft regulation that will allocate a protected status to financial transactions conducted under GMRA and ISDA best practice documentation. And I just got word today that the draft has now been approved in principle, so we're going to be moving to the next level. As a Ugandan banking sector panelist had said inside the webinar, this is a game changer for the market, providing the legal certainty that will be needed to offset some of the credit risk perceptions. Just this past year, and by way of a notice to the general public by the Bank of Uganda, it prescribed that all GMRA-based repos qualify as eligible financial contracts to which netting arrangements apply. Frontclear and Bela, a local law firm backed by ISDA and ICMA, are actually working together to review all the regulations that have changed in the last year and ideally move Ghana towards a clean opinion for the country, which of course affects its status, standing, and the security relative to investors in interbank markets. In Ethiopia, the National Bank and Frontclear will be backed by FSDA and FCDO, are embarking on a project to design a CSD for government securities. They recognize the need of effective settlement infrastructure to a reliable secondary bond and repo market. It's worthwhile underscoring that development of resilient money markets start with detailed diagnostics. Frontclear and its partners EBRD and OG Research, we implement what we call the Money Market Diagnostic Framework, or MMDF. We've completed it now in over 10 countries, and the MMDF is a very useful in-depth analytical exercise. You can imagine with a lot of the barriers and the points that Judith and Sherilyn have pointed to, that it's quite daunting for regulators to consider, where on earth do I begin? What building blocks do I start with in order to kind of build the interbank market and the money market in a way that's going to be productive and in a sequential manner that works? So the MMDF that we have is designed exactly for that purpose. It's meant to give central bank regulators insights into the current status or a baseline of their money market and help them to prioritize interbank market development initiatives all towards that resilient market. The MMDF, again, is out there. It's a tool that we're happy to apply in any emerging market developing country. I'm also happy to share that we're actually embarking on a piece of interbank research ourselves, something that we feel would be incredibly helpful for how we measure our impact and our efforts to serve central banks and to work in markets to improve the interbank segment. And our lead researcher on this will be Esme Kanyumba, who is actually doing her PhD in this field, and while she's employed at the Central Bank of Malawi. The target of the research is going to be to develop a set of practical and usable impact indicators to measure impact market development. It expands on our own institutional theory of change, where we have impact indicators, but quite frankly, we're not 100% convinced that they're comprehensive and that they're the best set of indicators to be able to measure a baseline and to track progress over time. So we're going to do this together with Esme and apply these indicators firstly in Uganda, where we'll be shortly launching an onshore guarantee facility for a wide number of Ugandan banks transacting interbank. We really look forward to developing these set of comprehensive indicators and are grateful to Judith, who's agreed to be part of the advisory committee for the project, together with a number of quite notable individuals. So for Frontclear, our target is really to support regulators and interbank market actors to, simply put, develop those more resilient financial systems, recognize the importance of participatory and inclusive interbank markets that this study really, really does underscore with great detail and attention. Thank you for your attention, and I'm happy to answer any questions later. First, I'd like to hand over to Victor again for the second speaker. Thank you.
Thank you very much, Ingrid. You have covered, a very important area, looking into the technologies as well as the soft side of the technology, which is regulation. So let me call upon Samir Tiliong, whom I had earlier introduced. Samir, if you could do it in, say, 5 minutes, that would be most appreciated.
Okay. Thank you very much. I think I join Ingrid in thanking the organizers of the meeting, the webinar, and really to discuss this topic of great interest, which we can talk about for the rest of the day. But because of the constraints of time, I think we go straight into the issues that are related to the subject matter. I'll do my discussion based on the experiences from the Kenyan banking sector side. And this is with regard to the operations of the interbank market. And this is really to draw your attention to some of the developing aspects that may be of interest for purposes of assessing the performance of the interbank market in Kenya with regard to progress, the barriers, and the policy implications that we're looking at today. So first is to really discuss the aspect of market infrastructure. So as we talk about opportunities for enhancing the market infrastructure, what exactly are we looking at? Is it the trading platforms? Is it the collateral perfection process? Is it the information sharing platforms? Or is it really the influence of other market developments? Because it's of interest to note that this would actually be at varied stages of development across the different countries. For instance, in Uganda, you would have a better or more developed information sharing platform on the infrastructure than in Kenya, for instance, which differs again from what happens in Zambia and in Malawi. So I think it is important to point out aspects of market infrastructure that would need interventions. And I think Ingrid alluded to this in terms of, if we're talking about the collateral within the infrastructure framework, are we looking at a CSD? Are we looking at horizontal repo experiences like what we had in Kenya? Or perhaps even when we are looking at the aspect of collateral, for instance, is it really the availability of the collateral, or it's the perfection process at the end of the day? Because for Kenya, there was a collateralized interbank market through the horizontal repo market. And this did not pick up because there were issues with the legal framework for perfecting the realization of the collateral in the event of a default. So that points to aspects to do with the legal framework that is in place. Is it supportive of a development of the interbank market? The other component that affects the interbank market operations is really the operations of government. Because in most of the Sub-Saharan African countries, I think the government is a banker of government, the central bank is a banker of government. And any operations emerging from the government side, either there is a gridlock in spending or there is overspending, so that then it directly influences on the liquidity conditions in the market. That has to be acknowledged within the space of interbank market development. And I'll draw your attention to two papers that have been done. This is a paper that was done in 2012, which really covered the liquidity and liquidity in the interbank market as well as versus the developments in government deposits. It was done at the Central Bank of Kenya by Sichei, Moses, and others, including myself. The next paper that was done recently was one that was done by the Kenya Bankers Association, which really looked at whether the interbank market picks signals from the government securities market. And it found that the interbank market actually is influenced by developments in the government securities market. And this was a paper by Osoro and Mureithi, the Kenya Bankers Association. Again, I would draw your attention to sample some of the papers that are posted on our website. And I'll also make a few references with regard to some of the structural challenges that happen in the credit market, especially in lending to private sector, that have a bearing on the performance of the interbank market. Because at the moment, the Kenya policy space moved out of interest capping period in 2029, and now we are in a space where we are supposed to have risk-based pricing. But then the pace of adoption of risk-based pricing remains highly constrained. And because of this, the extension of liquidity to private sector as loans has kind of been constrained to a large extent, and that affects the liquidity conditions in the market, which of course has a bearing on the interbank market. So gridlocks in terms of extension of credit to the private sector feedback into the interbank market, and no wonder we see deviations of the interbank rate from the policy rate, which is something that has been alluded to with respect to the transmission of monetary policy signals. The other component is the transition of policy towards inflation.
Oh, we seem to have lost Samuel. Hello, Samuel. And Samir's microphone is muted. Okay, that was interesting discussion drawing from the research at Central Bank of Kenya and colleagues.
Okay, can I continue now? Sorry.
Yeah, yes, please, if you could conclude, yeah.
Yes, sorry for the connectivity challenge. So the next aspect of interest is really the focus on the structure of the liquidity management at the central bank, which is also of interest to the interbank market, because we'll then be asking ourselves, when there is a window, the access of funds window, which is a measure of last resort, it's actually supposed to be a measure of last resort, but if there are heavy constraints on access to that window, then there would be challenges to liquidity management within each commercial bank. So for instance, the Kenyan one is highly penalized when a bank accesses the central bank window for liquidity support. And this has been stigmatized to a large extent, and therefore banks have to keep excess liquidity because of the unavailability. It's unavailable to provide liquidity as a measure of last resort. So the structure of access to credit from the central bank also has a bearing on the interbank market. Then there is also need to understand, and perhaps for researchers in the group, is they need to do threshold analysis, because liquidity in the interbank market affects the outcomes of the market in varied versions. And I think it's non-linear to a large extent. So they need to point out the threshold points of changes in the interbank market. And this has, again, a bearing on the effectiveness of the policy signals that are sent. And of course, I can't come from Kenya and not talk about financial innovations. So when you're talking about financial innovations have kind of blurred the liquidity management practices in commercial banks, because it's not quite, for an analyst, you wouldn't be sure whether money in held on a mobile phone is in the bank or is outside the banking system. And that has implications on the liquidity management practices of banks. there was the mention of guarantees in the interbank market, which is a welcome idea. But then we ask ourselves, if we talk about guarantees, assuming that they are adopted to a large extent, how does that affect the organic development of the interbank market? Because again, we have in our literature that peer monitoring is an effective tool. So to what extent would guaranteeing help in the development of the overall market without the support of the guarantee system? So some of the recommendations that have been put forward, and I think it is important to analyze this, is that the recommendations, yes, are good, but then I think it would be important for interbank markets in Sub-Saharan Africa to look at the possibility of, are there benchmarks that we could actually look out for? Are there best practices that we could be targeting to grow the interbank markets towards? I think I'll end my comments at that point.
Thank you very much, Samuel, for those very constructive, highly relevant, observation. And importantly, the last one you mentioned, which whereby transactions can be based on trust and peer monitoring rather than collateralization. So let me, at this juncture, open the discussion to the floor. Please, if you could put your hands up. There is a hand up facility, and please restrict, summarize your question, introduce yourself, your name, affiliation, and then the question. I'd like to collect as many questions as possible, although we are remaining with very short time, and then we can go back to the speakers. Okay, I don't see any hand up. So may I check with the G or Elaine Stefan, see whether you can see any hand up? No, I can't see any hand up.
Yes,
I can
see Alistair.
Yes, yeah, Alistair Loughborough University. Alistair, please go ahead. You are still muted, I think.
Alistair, can you unmute Alistair?
Okay, it's done. Alistair, you have the floor now.
Thank you very much. I also have to go very quickly. So I'm doing quite a lot of work on central bank digital currencies, and there are implications for money markets, and there's also interest in a number of central banks worldwide, including some central banks in Africa, in Sub-Saharan Africa. Could this be potentially a challenge for interbank markets, perhaps moving liquidity out of the banking system onto the books of the central bank? And is this something which should be addressed in terms of this fascinating research agenda?
Thank you, Alistair. Can we take another question, please?
There's Anosi.
Anosi is also working on the interbank market, actually globally, on new theories and use of artificial intelligence. So Anosi, please go ahead.
Thank you very much, Victor. My question is pretty much around the issue of collateralized interbank transactions. If we move to a system where almost all interbank transactions are collateralized, and that would remove the sort of peer monitoring role, of which evidence shows that peer monitoring can actually be quite effective. And yeah, I think my question is pretty much around how do we really establish if that is the way to go, or if the peer monitoring mechanism is actually sufficient enough in ensuring the smooth running of the internet market.
Thank you, Anosi. Very relevant. Can we take another question? Are there any hands up?
No.
Alain? Okay, so I'll go to the chat room, and I can see a question from a question from no, that's just a quick comment. Yes, a question from J.R. Rao. How feasible is the possibility of the interbank lending rate being the benchmark for loans in the country, where there are challenges in the Anglophone countries? The big challenge I see is the lack of reference lending rate in the CFA zones. And I think that's relevant for some of the people here in the audience as well, who are talking to BCAO regarding the interbank market in YM. There is another question to consider the structure and development of interbank markets in Sub-Saharan Africa and the potential introduction of central bank digital currency and its use in providing both domestic and cross-border payment liquidity. Then a connection and just relevant to slightly different. And yeah, Alistair has already asked a question, is also on the chat. Then from Philip Bysks, has it been difficult to get comprehensive cross-country data on the state of interbank markets in Africa? What can be done to improve access to this data? I thank all the central bank governors that have made it possible for researchers to access the data. Data access is a very big challenge. And Anosi, who is doing a comprehensive, will testify, because even getting the data from the European Central Bank countries has also not been easy. Then Emily Tant, yeah, Emily, yes. Emily, that's ODI. Has it been difficult to get comprehensive? Yes, okay, that's can be done. Yeah, that's okay. And then Andur Jarir Ibrahim, Islamic banks are constrained with interest and cannot participate in overnight placement as a liquidity tool. With an increasing penetration of Islamic banking in Sub-Saharan Africa, central banks in Africa consider alternative liquidity tools for Islamic banks, and the convention tools do not meet the non-interest constraint of riba. For example, in the UK, alternative liquidity facility for Islamic banks in 2021. And that's a very, very important point, given not only Islamic banks, but Islamic window components in the conventional banks. Okay, and then there was Jan Topruske, great to see you on board, yes, and is drawing the example of Europe, North America, and East Asia interbank markets, the role they play in unsecured lending. Okay, I don't think I have missed out any question so far, but there is also a question from another question from Edie Hussein, who says, how will the Africa's interbank leverage in digital financial services to ease monetary transfer among financial institutions in Sub-Saharan Africa? And I think that's very important for developing cross-border interbank markets in Africa, which I think is the next important dimension to be considered in this research. What I will do now, in the interest of time, is to ask all the panelists and guest speakers to give us something that I would like to refer to as a soundbite. A soundbite, just one sentence that concisely and succinctly summarizes what we should go with, the takeaway with. If that could answer some of the question observations, that would be helpful. But at least, let's see something that we can go back to, given the interest of time, since we're remaining on about 1 minute. Okay, so I'll go back to the speakers. I will start with Sherin, I go to Judith, and then go to Ingrid, and finally to Samuel, in that order. Sherin, your soundbite.
This is I mean, with all the interesting questions and all the details that we've discussed, there are lots of like nuances that I would like to share, but maybe, yeah, I'm open to have open conversation with anyone with this. But for my soundbite, like I think information disclosure is the very first step to address all the market segmentation and high level of perceived risk. And this is the key barrier, like it can unlock the potential of the interbank market in Sub-Saharan Africa.
Thank you. Reduction of opacity and reduction of asymmetry. That's the way forward. Thank you very much. Judith, soundbite.
My soundbite would be that we need to crack the problem about the collateral. We obviously had some different opinions. I see Jan's just put a great comment that is an alternative use of swaps rather than securities as collateral. But we also need to not, I think, abandon it, particularly because of its importance during periods of market stress, and where we see only peer monitoring, that can be a significant accelerator of systemic disturbances.
Thank you very much for that, especially on peer monitoring, which has both sides of it. Can be good for propagation, it can be good for regulation. Thank you very much. Ingrid, soundbite.
Yeah, soundbite. I think that we understand the challenges. These ladies have analyzed them and summarized them quite well. I think that the time is now, not tomorrow, to start to tackle them effectively. And I will leave the audience with the experience and understanding is when you have a driven regulator together with a very aware market, anything can be done. And we see that in a number of sub-Saharan markets, the level of development is very speedy. So a driven regulator and a driven market together.
Thank you very much, Ingrid. Very helpful. And Samuel, your soundbite.
Well, the interbank markets in Africa are growing, but the interbank markets in Africa are growing, and they need to be supported from whatever policy measures, structural measures, and legal frameworks for them to grow better, because getting back into support systems will not help, but supporting organic development of the interbank market would work. Thank you.
Thank you very much. And there are, other issues. This was just to whet your appetite into looking in interbank market in Sub-Saharan Africa. Issues, for example, like the banks which are in the core and the banks in the periphery, the core periphery structure of these banks, which you can explore more. My own soundbite would be that given the growth of cross-border Pan-African banks on the continent, Africans, indigenous banks that have become conglomerates, more research should be done to inform enabling policy for cross-border interbank markets in Africa, because our banks are cross-border. I would like to thank all the panelists, the guest speakers, you in the audience for all this constructive engagement. I think this is only the beginning. We shall be seeing more and more activity in the interbank market. At this juncture, it's my great pleasure to pass on again to G to conclude this meeting. Thank you, G.
Thank you, Victor, and thank you to all panelists. On behalf of Making Finance Work for Africa, I would like to thank also the participants. All questions will be collected if we haven't answered them, and we'll provide holistic answers via email to the participants. Our special thanks also go to our chair, Victor Morende. Thank you for chairing this session. For those interested, let me tell you that SOAS run a series of very, very interesting seminars. So please check out the website of the Center for Global Finance at soas.ac.uk. The series of webinars with ODI continues. Next, in 2 weeks' time, on April 15, we'll host another webinar on the impact of Pan-African banks on financial development in Sub-Saharan Africa. This is the title of another study by Sherilyn and Judith. So please stay tuned and register for the very next webinar. Of course, a copy of this study is available on the ODI's website and also on Making Finance Work for Africa's portal. Please feel free to reach out if you need to get the link in your email address. And if you have any other question, please feel free to send us an email. Once the webinar ends, you will see a survey. Please fill out the survey. We're eager to hear what you have to say, the kind of feedback we need to improve our sessions. You also receive a follow-up email within 72 hours with a link to the recording and some of the presentations. And finally, on behalf of the partnership, on behalf of ODI and the SOAS Center for Global Finance, thank you so much to you all, and stay safe. Have a good day.
Thank you very much.
Thank you.